Hi, and welcome back, everyone. My name is Michael LeBlanc, Senior Portfolio Manager at Canaccord Genuity Wealth Management, and thanks for joining us here for our tactical portfolio update. As always, remember everything we cover on these videos are for information purposes only. Always reach out to us, reach out to a professional for specific advice, or do your own due diligence before investing in any strategies out there. So with that, let's jump into things. Thank you all for joining us back. We've been on a bit of hiatus here for the summertime. Has been a little bit, just over a month or so before we've done a video. We are going to get back onto a regular schedule, so you can look forward to those. We have changed formats. Obviously, a lot of things have happened since we last talked. So one, you've probably seen the announcement, and you'll notice the logo up here, LLC. So the LeBlanc Group is now LeBlanc or Leishman LeBlanc Catlin Group. So we merged our two groups. That's been going on for quite some time. We sent out a big announcement. Hopefully you had a chance to look at that. If you haven't, and you have any questions on that, just give us a call. You probably won't see too much change as far as the services and information you're getting. Maybe some more additional as we bring the strengths of the two groups together. And if you have any questions about some of the new stuff that you're seeing, by all means, as always, reach out to us. We're happy to chat and tell you about that. But that's not what we're talking about today. So the formats that we've changed the videos. Historically, we've done the live videos, more of a market update. We still are going to do that, but we're going to focus on our portfolios that we manage for clients on the discretionary front. So the managed portfolios. And we're going to talk about the markets and how that's affecting our position in those portfolios and what we're doing in there. So we're going to talk kind of what's been going on in the summer, what we see coming up, and of course, what's happening right now. Also, we're going to be putting out the Mike on Money videos. Those are still going to continue. Those are going to be very topic related, so you should see those every other week. And Harold Leishman, my partner, is going to be doing interviews with some key players in the portfolios, especially on the smaller cap side, talking to some of the CEOs and other people in the industry that will have insights on what's going on in those markets and how you might be able to take advantage of that. So a lot of things going on, but with that, let's kind of jump into what we're seeing in the markets out there and kind of what we should be expecting in the portfolios. Now, of course, the big thing out still playing on the markets, or the big theme out in the markets today, is still inflation. That hasn't changed. I don't think it's going to change probably for the rest of this year. It's the main underlying mover of the markets, and of course with that interest rate. So what are we seeing and what do we expect to see? Now, before I start talking about what we're seeing right now, because I know it's all doom and gloom out there, all the talk is recession and all these different things. We're gonna dive into all the effects of inflation or what we're seeing right now. But the one thing to keep in mind when we talk about inflation or recession is all the numbers, all the information you're going to see is always backwards looking, right? So inflation, we've got to go three quarters of negative growth. So that means you won't see, or you won't officially find out if you're in a recession until you're already in it for almost 9 months. So you could easily be coming out of it by the time you actually realize you were in it. So all the information is about a month or so old that you get, and inflation is very much the same when it comes to that. So we get inflationary numbers, but they're from the last month or the month before, depending on which numbers you're looking at and how accurate those numbers are. So when we take a look at what our expectations are in the market, it has to be forward looking. What do we expect happening moving forward? So inflation, the big theme out there. Yes, the numbers are still high. Yes, they're a lot higher than the Bank of Canada or the Bank of the US, or even the global banks, as we're seeing, of course, in Europe, is out there, and it's been bad. And a lot of people point and blame at different things, and some of them are true, and actually they're all kind of true. So one is, of course, the pandemic, which shut down the supply chain. All that had a backup and a push up on prices. And if you listen last year, there was a lot of talk of things like transitory inflation, meaning that this inflation was temporary, just caused by the supply chain. And once the supply chain got itself fixed up, that inflation would go away. And that's where you saw the central banks around the world basically saying, hey, this is transitory. We're going to hold off interest rate hikes until, and they had the original target of 2023. So kind of at the beginning of 2021, the goal was 2023 before they wanted to do any interest rate hikes, let the economy kind of go on its own and run on its own. That obviously didn't happen because the supply chain issues created real inflation as well as that transitory. So we got into the beginning of 2022, central banks decided, oh my gosh, we waited a long time, almost too long. We need to start hiking in 2020, early 2022. But just before they started to do that, of course, we had the Ukraine-Russian war breakout, which actually spiked that inflation in the supply chain. All the sanctions that are on Russia, of course, they cut off the supply out of Ukraine, especially when it came to food and fuel, and we've seen that at the pumps. All that kind of pushed up an already built-in theme of inflation. So, you know, all these things kind of hit at once. Then the last thing that we're seeing a lot of blame on, out there is on the relief packages, right? All the governments kind of flooded the market with cash, with capital, whether it was CERB here in Canada or in the US. You know, they got the support checks. All this money was dumped into the market. You know, having given people more money to spend, driving up the demand side, all while we had the supply chain issues. Now that needed to happen. I'm not blaming, you know, those systems or relief packages that went out as being a part of where we are today. They contributed to it. They could have been better. Hindsight's always is going to judge that, but all this kind of happened all at once, kind of this perfect storm. So, you know, when the central banks went to go raise those rates, they were behind the game. They waited too long because not only was inflation not transitory, as I said, the Ukraine war, and then all this flood of cash in there all kind of hit at once. So as that all hit, the central banks all of a sudden slammed on the gas with the or brakes with interest rate hikes, jacking them up very aggressively, very quickly. So that's the boat we're in right now. Now, I would say, and everything that I'm looking at is telling us they've gone too hard, too fast on interest rates. Doesn't mean there's not going to be another hike. It's probably going to be a lower hike, even in the last US Fed came out with their 75 beeps, or 0.75%. They even said in their language, they went from very hawkish language saying, whoa, we might have to be more aggressive than expected, to kind of saying, I think we can ease off a little bit. So you probably see the next hike being lower, probably 50 basis points. And the market's going to breathe a sigh of relief on that because, you know, the hikes that were expected are already priced in the market. The market's already looked at that and said, hey, we know this is coming. We're not worried about it. What we want to know is what's going to happen going forward. Are we going to be surprised to the other side? So things are looking good on that front. If we look at the inflationary front, so those numbers that we're worried about, we're starting to see them turn over. You know, even gasoline's come down a bit in the US and Canada, not that much in Canada. And I wouldn't look for that to go back to where it was, but just that it's easing off. It's not climbing anymore. We're also seeing inventories and warehouses going through the roof. It's a symptom of supply demand channels that seems to repeat itself. You think businesses would get better at that, where they see, you know, an increased supply, or sorry, demand issue and short supply. So, you know, they put the foot on the gas to make as much product as possible to fill all this demand. And then if demand comes off just a little bit, all of a sudden you have a glut coming in. And that's kind of the situation we're having. We saw that if you look at the Walmart results. We're seeing warehousing, industrial warehousing in the United States, basically bringing in empty trailers to store the overstock that they have in there. We're seeing the shipping demand, logistics around the world basically falling out as far as demand goes, or certainly dropping off massively from 2021 levels, all showing this supply excess and demand fall off, caused by interest rate hikes, but also, you know, we talked a lot in our videos in 2021 about, you know, that sharp demand as people started getting back to things, and then it falls off a little bit afterwards. I think if you want to look at a textbook example, if you look at Peloton stock, so if you followed that story during the pandemic, of course, Peloton was the home fitness workouts and bikes, and they just shot up, of course, in value. The demand for the bikes shot up. You couldn't even, it was 3-month waiting lists. So they pumped up the manufacturing. They pumped up all their their services. They took advantage of that stock price increase. But then as soon as the pandemic it kind of reopened, especially in the United States and here in Canada, demand's fallen off and that stock has just completely been decimated. So that's a kind of a textbook example of that supply chain kind of just going overboard. And that's what we're seeing on the inventory side. So prices are coming down. Walmart has announced after the last one they were going to be slashing prices going into the summer and fall just to try to make up on the revenue side of things. And we're seeing that kind of as more and more earnings reports come out. So that's what we're seeing on pricing. The one area that hasn't really come down yet, it's probably going to be a little bit longer, is the food side. So when you look at the price of foods over the last year, we've seen massive increases. Certainly, for the mid to the lower income households, having to absorb that is a big impact. Of course, the Ukraine situation has had a bigger impact on that, and that's not easing up too soon. I know we have seen a couple of grain shipments coming out of the Ukraine, which will improve things. And more and more that becomes steady. If that can become steady in the shorter term, that will ease some of those areas. But there's a lot of other issues around food. I was reading about the corn crops. We've got this weather causing problems for farmers, and then also on the meat front, livestock populations are down again due to the weather, and also being able to get food or feed for them. So the food front is the one that's probably going to linger around a little bit longer when we talk about inflation. So I wouldn't look for that just to ease off as quickly as all the other ones. But overall, what we're seeing is that those inflation numbers probably turn over, and probably going to turn over faster than we expected, because again, we're going to get we might see July's number come out a little bit softer on the inflation front, easing off a little bit, but probably not the optimistic number you want. But then by the time we get the August and September numbers, they're probably going to come off a lot. Now, again, they're going to be a backward number. We're not going to see those to the end of October, maybe early November, but the market's always looking ahead. So when we're talking inflation and interest rate, the actual picture is looking pretty good from a recovery standpoint for the markets. Doesn't mean that I think we've hit bottom in the market, or we won't retest the bottom. We definitely, still see some volatility because there's still a lot of this news coming out there, but the picture is actually getting a lot more optimistic from a portfolio perspective than you might be seeing out in the news. So that's kind of in my view, a good thing. So what does that mean around recession? Well, again, you probably heard me say, I think we're already in a recession. Those numbers aren't going to tell us that, until the fall, but I think we're already there. The U.S. has already had 2 quarters of negative economic growth. So one more quarter and we're there. But that doesn't matter, because we've already absorbed that. That's already been priced into the markets. And if you want examples of that in your portfolios, or even in the broad markets, it does, recovery in the markets doesn't mean lack of bad news. It means that it's been priced in. And if you want more and more examples of a recession being priced in and the rate hikes already being priced in, look at the recent news that's come out. So we had, a few weeks ago, we had the Bank of Canada surprised with a 1% hike. So they had projected they were going to do a 0.75%. They surprised to the upside with a 1% hike. And what happened to the markets? Nothing. The markets just shook it off. They're like, yeah, I know, bad news. We expected it. It's fine. Just move on. We went into the U.S. earning report started coming out. As I mentioned, Walmart came out with disappointing numbers. We saw a bunch of tech companies come out with some disappointing numbers, and all that. And what happened in the U.S. market? Nothing. The market shook it off and said, yeah, we knew they weren't going to be good numbers. And all the analysts and all the market expectations all came out with updated lower expectations for the next quarter. So they've lowered it down, saying, yeah, we know it's bad. We know we're in a recession. We know that the next quarter is not going to be good. So we're just going to lower our expectations. So think about it, hearing horrible reviews of a movie, and then you go to the movie and you go, it wasn't so bad because your expectations were really low. And that's exactly what we're seeing happening in the market. So where does that leave us as far as buying opportunities? Well, pretty much, as I said, I don't know. I don't think we're out of the volatility days, meaning we're going to have still have some bad days. We've had a little bit of a rally here in the market, bounce off the bottom. We might retest that bottom. We might go slightly lower, but I think most of the carnage is gone. And we are starting to deploy, which I'll talk about in a second when I talk about a recent rebalance we did there. So really what we're seeing in the markets, it's a time, if you're an investor and you want to take advantage of these down markets, which is the best time to take advantage of those types of opportunities to get the really solid returns, now's the time to start looking at the market. Doesn't mean you're going to get at the very bottom, but most of the carnage is gone. There's opportunities out there. There's great dividends being paid. There's really low valuations if you're looking at the more torquey growth companies as well. You still have to do all the fundamentals. You still have to do all looking at the companies, looking at the revenue generation, look at what's impacting that. But that being said, the message right now is basically, if you've got cash, get ready to deploy, get it into your accounts, get it ready to deploy and start taking advantage of it. Because it's not something you're going to turn on the switch the next morning and say, hey, let's get all this cash invested this morning. It's something you want to be very targeted about the names you're buying, the amounts that you're buying. Maybe you're going to, average in a little bit. Certainly that's the approach we take in the portfolios, is to move money in gradually, because as I said, that volatility is still going to be there, but you want to be able to take advantage of it, because that first 10% off the bottom, the first 10% return off the bottom is always going to be on bad news. Bad news is going to come out, but those key, well-researched names are going to start to lift first. You're going to start to see the returns off the bottom, and those names, that's that first 10% off the bottom recovery. And then everyone's going to start to say, hey, things are getting better. And then you start to see more and more cash flow in. But if you want to take a real advantage of these downturns, is to go in with confidence, knowing that most of that carnage is gone, and you're taking advantage of things. So what do we do in the portfolio? So we just did a big rebalance in the portfolios. If you haven't looked, you'll see it there. I won't say anything dramatic. In fact, despite what all I just said, we actually came out with a slightly higher cash position. So we had a really strong cash position going in, about 23% in cash in our mid-range portfolios, depending on where you are in the risk range. But we had a really strong cash position to take advantage of these downturns. We're sitting just shy of 30% right now. That doesn't mean we raised because out of concerns, is we want to deploy into more targeted areas. So we freed up a few positions that we just felt weren't really working for the portfolio right now, and over the next few months probably not going to be the key performers. We added into the industrials, the dividend payers. Nothing's better than picking up some stocks that are paying anywhere from 6 to 8% dividends at these low levels. And if we have to sit through another month or so of volatility, but getting paid that 6, 7, 8% while we wait for that first lift off the bottom to happen, then we're happy to do that, because those are solid additions to the portfolio's returns for the year. So we beefed up some of those positions. We added some news. I mentioned some more industrials. We added Canaccord. We added Mueller. We added Wire, Copper in the US. We added a couple of healthcare equipment manufacturers. So we're starting to diversify the portfolio out where we see things recovering first, and those high cash flow companies that are paying us those dividends. So we have a healthy cash flow portfolio right now, and we've got that just shy of 30% cash ready to start deploying. And we are going to be deploying it here through August as we see the opportunity. So if we see a bad day out there in the market, that's not anything negative for us to be looking at. That's something we're going to add. And some of those new names we didn't go full bore in, as I mentioned. We started to build an exposure, and we'll start to build on that. So you'll see in the portfolio some names with just like a 1% weight in. That's just, we just didn't want to go in all because at once, just because that volatility is not completely gone. And we want to weigh in when we see some better pricing out there. So if you do see some of the names fluctuated, again, not a concern. We are going to be adding to those to take advantage of that. And we do see going into that, very positive, or moving into a positive second half to the year. Certainly comes from the portfolio perspective. Economically, sure, there's still a lot of challenges, and we're going to be facing those challenges for a while. But that doesn't mean the portfolios have to suffer through that whole process, because we are able to pick up, at these valuations with that cash flow that's being pumped through whether dividends or even on the fixed income front, on the bond front. We've been able to pick up really cheap no bid portfolios, high quality no bid portfolios paying 8%. And I know they don't look great on paper right now, but you're collecting that 8% in the meantime. And as those things recover back again, as they will, we'll get that lift on the valuation side. So all things are looking really good in the portfolios. We really like what we're seeing, and you're going to see a lot more activity going into the fall season here as we build out the positions and deploy that cash. Now, with that, this is our update. I wanted to get something out because there's so much happening in the markets and the portfolios right now. You can always get these on podcasts. Mike on Money, you can always grab those on YouTube, on replays. We'll post those to our site. We have a new site with the LLC, so you can go check that out. MikeOnMoney.com is still my main portal for the videos, so you can still go through that link. And as I said, we're going to get back onto a regular schedule for you on these videos and keep you up to date. But as always, any comments, any feedback, love to hear it from you guys. Any questions, reach out to us. We're happy, email, phone. And again, MikeOnMoney.com portal. You can reach me directly through that as well. And we look forward to ending off the summer on a positive note and hopefully seeing you all in the fall. So with that, thank you, everyone. Take care and talk to you soon. Bye now.